Hello everyone out there. Welcome to our YouTube channel Finbuzz Learning. So, in today's video, we are going to discuss the concept of bills payable in detail. So, without any further delay, let's get started. Now we will first understand that what does bills payable means. So, the bills payable are the short-term loans that banks take out from other banks, frequently from the central bank of the nation. To maintain reserve requirements and sufficient liquidity, banks will borrow money from the central bank or other banks. It is also known as accounts payable. Let's understand this in detail. So, bills payable in the context of banking refers to a bank's obligation to other banks, typically to a central bank like the Federal Reserve Bank in the United States. These are short-term interbank loans secured by the promissory note of the bank and the pledging of government securities. These funds are borrowed by banks in order to keep acceptable liquidity levels, known as needed reserves. Banks must have a specific amount of cash on hand, depending on their loan portfolio, to ensure that there is enough liquid cash on hand for depositors to withdraw. Insufficient funds can result in a bank run, which could lead to a bank's failure unless immediate action is done. Banks may also borrow from other banks that happen to have extra reserves on a particular day in addition to the central banks. Banks can lend these funds to those in need with interest rather than holding on to this additional money indefinitely. The loans in question are therefore extremely brief, frequently lasting just one night. As we have discussed earlier, that bills payable are also known as accounts payable, but there is a little difference between both the terms. Now let's know the difference between bills payable and accounts payable. So as we have discussed, accounts payable is distinct from bills payable. So the accounts payable is an account category in the general ledger that track current obligations as opposed to bills payable, which refers to the actual invoices vendors send you as a request for payment. Bills payable are recorded as a credit entry in the accounts payable account. The short-term debt that your company owes its vendors for the items and services they have given is documented or recorded under accounts payable. A payment term is connected to each bill paying entry in accounts payable. An invoice from a vendor can include, for instance, that payment is due within 30 days after the invoice date. On a company's balance sheet, accounts payable is shown as a current obligation or current liabilities. All the liabilities that must be repaid by a business within a year of the balance sheet date are referred to as current liabilities. A balance sheet is a type of financial statement that summarizes the assets, liabilities, and shareholders' equity of a corporation or company on a particular day. Now coming to the notes payable. So what is notes payable? A written promissory to pay a certain sum of money by a specific date in the future is known as a notes payable. In other words, we can say that notes payable represent debts made by one party to another. Notes payable are reported as liabilities just as accounts payable. However, accounts payable and notes payable are little distinct from each other. Accounts payable, in contrast to notes payable, lack a corresponding formal agreement. Accounts payable entries do not have interest attached to them. However, notes payable do have. Accounts payable are short-term credit transaction, whereas a notes payable is a corporate loan. So, we have studied bills payable so far. In the next video, we will be discussing the difference between bills receivable or accounts receivable and accounts payable in detail. Thanks for watching our channel, and do not forget to like, subscribe and share the channel among your friends and relatives. Thank you again.